You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. With us today is our good friend, Rick Rule, and we're going to get the latest on what's happening in precious metals, the markets. Is the bull market in silver and gold over? Rick, it's great to have you on again, and hope all is well.
Kerry, it's very nice to be back. And in answer to your question, things are going quite well, thank you.
So, like the volatility, this is what really separates pros from the amateurs. Because if you can't control your emotions, when you see what happened in silver, $120+ an ounce, down to 64 in the blink of an eye, and, buckle your seatbelt time. But the newer people investing in the sector, this kind of movement freaks them out. Let's face it. They're just not used to this unless they've been playing Bitcoin for more than 6 months, right?
Kerry, when I was a very young man, I was actually a pretty good trader. I would try to trade these short-term swings. My investment goals while I was still in university were, want to trade 4 snow tires and dinner with a date at a nice restaurant. I have very focused goals and very, very period of time. And volatility was useful for me then. I learned very young that a chart with a parabolic up move was going to have an equally sharp retracement. Maybe not for the whole up move, but it was going to have a very sharp retracement. And a parabolic down move would also have a correction. Those charts that the Canadians call hockey stick graphs cause one to understand that the backside of the stick is just as steep as the front, but somewhat less fun if you're long. Now that I'm not a trader, I sort of regard them as noise. I think you, sold most of my physical silver, and I guess partly about that volatile move, but mostly because the silver that was in my portfolio was in my portfolio as a consequence of the fact that silver was a hated asset. And when it ceased to be a hated asset, the reason that it was in my speculative account went away. And when it went away, 80% of the silver had to go away, or didn't have to go away. But I just did. I decided I'd look somewhere else for hate.
All right. Well, I'm going to do a clickbait headline here. Why is Rick Rule selling his silver?
Why has Rick Rule sold is probably a better,
sold his silver.
The 20% I have left is, likely not going to be sold for a while. I believe, Kerry, that the primary bull market in precious metals has a long time to run. I believe that the decade that's in front of us resembles in some way, shape, or form the decade of the 1970s. Specifically, and I've said this in our interviews before, I believe the U.S. dollar over 10 years loses 75% of its purchasing power. That's what happened in the 1970s. So I believe that gold and silver have further to run. I also believe that the pace of the run that we saw in 2025 probably can't be repeated. I think that late 2024, late 2025, I think the move that you saw in gold and silver was pent-up energy. It was the fact that gold didn't move in 2020, 2021, 2022, 2023. And I think most of the pent-up energy, which is to say most of the price move that's a consequence of past underperformance, is now out of the market. So people need to look forward for the gold trade. If they don't see the gold trade the way I do, they should decide that the easy money has been made, take their money off the table and go somewhere else,
Yeah, so about that, and, looking at it where you have that major move, and then for some reason we always want to think that this time is different, that somehow the parabolic move is going to continue indefinitely into the future, because this time really is different. But I'm always think back to Benjamin Graham, the tree does not grow to the sky.
Correct. It's also useful, I think, for the generation of players 20 or 30 years younger than you and I, who didn't experience the decade of the 70s, to revisit it in the sense that in the 1970s, I would suggest in response to the deterioration in purchasing power of the U.S. dollar, the gold price ran, 25-fold?
Yeah.
I'm not suggesting, by the way, it rose 25-fold from here. What I am suggesting is that in the decade of the 70s, we had at least 25% price retrenchments. And we had one in 1975 that was a 50% price retrenchment.
I actually remember that. Yeah.
As do I. I remember from the long side, it was not particularly pleasant for a young man. But the lesson in all this is that cyclicality and volatility are inherent in bull markets. And if you aren't financially and psychologically prepared for it, you're going to get shaken out. The people who got shaken out in 1975, for history's sake, I should recount the facts. In the period 1970 to early 1975, the gold price ran from $35, admittedly price controlled, to $200. And that move, that six-fold move, attracted a lot of adherents.
Oh, yeah.
In 1975, the gold price fell from $200 to $100. And the newly faithful wish they'd never learned how to spell gold. Those who got shaken out at 100 must have moved from 100 to 850 over the next 5 years. There's all kinds of lessons there.
And then in 2000, it was back down to just under $300. Not till 1999. I bought
286, if I recall. Yes,
I got in at 288. So
nice print.
And I wrote it up and then down. And but in some respects, this time really is different, at least for silver, because we genuinely have structural deficits and booming demand. Does it make it different? Does it put a floor under silver that we wouldn't otherwise normally have if this was just a normal market run up?
I'm too old and smart to answer that question in a yes or no fashion. Mm-hmm. I'll talk around it. I've been trying to understand the silver market since the early 1970s at the University of British Columbia. Maybe I'm a dumb guy, but after 55 years of trying, I understand that I don't understand. Here's a few problems.
That's knowledge.
On the supply side, we don't really know what the above-ground supplies are. We know what the above-ground good delivery supplies are, but we know really nothing statistical about informal ownership in India, Pakistan, Bangladesh, and Sri Lanka. Is it 1.5 billion ounces? Is it 3 billion ounces? We do know that saving in silver has been part of the rural Indian culture, rural South Asian culture, I should say, for 1,000 years.
Yeah.
And they distrusted their government before we had a government. So there's a lot of supply that can come out in the right sort of circumstances. In terms of forward-looking supply, the deficit, we know that silver miners produce 18% of annual supply. The rest comes from byproducts of other materials and recycling. So the silver price doesn't necessarily stimulate supply. You have to look to the copper price, the zinc price, the lead price, and the gold price. It is really tough to get a handle on the silver market. Folks who trade news don't trade the whole news. People went crazy with the export restrictions announced by the Chinese. But the Chinese said that they were going to restrict silver exports to authorized exporters. They issued 42 export licenses to politically connected traders, which is to say this is more rent-seeking than it is market control. It's important in markets like these, Kerry, for the people who are going to trade news, which usually doesn't work in my experience, to read the whole article, not just the headline, before they try to trade on it. So that long soliloquy all goes to say, in answer to your question, I don't know.
But it certainly appears, though, that industrial demand is way higher than it was like in 1965 when they demonetized our coinage. And
that part is very true. Now, industrial demand becomes price sensitive at some point. Silver's reflective properties means that the point with regards to solar panels probably substantially higher than now, unless there's some technological breakthrough. What we've seen in past bull markets, and I'm not suggesting that past has to repeat itself, what we've seen in past bull markets is that industrial utilization of silver has continued, except for a 5-year period after the use of silver in photography.
And X-rays. Yeah.
That created a real slump. But it would appear with the germicidal properties of silver, the applications in water and wastewater treatment, and particularly with regards to solar, that industrial demand for silver for a while grows and grows and grows. We also know from studying history, though, that dramatic price moves in silver haven't occurred as a consequence of industrial demand. They've occurred in precious metals bull markets after the leadership of gold in those markets. The momentum of gold attracted generalist investors into precious metals markets. That's what's happened to the last 3 markets. At some point in time in that market, when the generalist comes into the market, leadership in terms of price momentum switches from gold to silver. And we saw that happen in spades in 2025.
Yeah.
Whether or not there's going to be a pile-on with regards to industrial demand remains to be seen. But the condition precedent for a silver price move, which has occurred in every precious metals bull market in my life, has occurred.
Mm-hmm. So, but yeah, I see your point, and I understand it, but it does seem like, well, let's go over 3 stories that are circulating in the silver market right now. Number 1 is Samsung has created a battery that is the greatest thing since sliced bread. You'll get 1,000 miles on your EV. The negative is it gobbles up silver like nothing else before it. Number 2 is the Chinese whale who made $3 billion as in trading gold. And as best as I can tell, he's real, and he did have a short position, but we don't know the other side. We don't know if he was doing spreads, cross-market arbitraging. We have no idea what this guy was doing, but he did have a short position. And number 3 is somehow JPMorgan has accumulated a short position of 6.2 billion ounces of silver, which is enough to basically destabilize the global financial system. That tells you something about what part of the cycle we're in as well, because these stories, they're just recycled and brought up to date, right?
And we could add 2 to those. A gold discovery in Uganda that apparently is equal to half the gold ever produced in the history of mankind. I spend a fair bit of time in Uganda, and that deposit has missed me, as well as every professional geologist in Africa. And a similar discovery apparently has been made in China, a gold discovery that numbers in the hundreds of millions of ounces. There's a word for this in English. It's horseshit. I can't speak to the Chinese whale because I don't follow traders. This whale may, as you suggest, exist. The idea that he's going to telegraph his short position, or that somebody is going to know about his short position if he's that good a trader, the probability of that, I think, is nil. As to a 6 billion ounce short position by JPMorgan Chase, that one is pretty simple with any access to the CDR database. The statement of financial condition for JPMorgan Chase is available. For those people who don't want to do that, let me tell you something about my experience on Wall Street, which is deep. The only thing that matters on Wall Street to employees of Wall Street is quarterly cash bonuses. Nothing else matters. Systemic short positions that cause an interest to be payable as opposed to receivable reduces quarterly cash bonuses. The people who are listening to this need to repeat after me. Nothing that reduces quarterly cash bonuses is allowable on Wall Street. Interest is to be received. There needs to be a net interest spread so that cash is generated, so that cash can be distributed. a 6 billion ounce short position would require, I don't know, it would require, at least in the derivatives, borrowing billions and billions and billions of dollars. And JPMorgan Chase would have to post margin collateral on those billions of dollars, which would cost cash, which would reduce quarterly cash bonuses. Any story that you read about a systemic short position on Wall Street going after years or decades, you can automatically negate because it reduces or eliminates quarterly cash bonuses. People work on top of Wall Street for quarterly cash bonuses.
And year ends.
Yeah, that's right. But, most of them aren't that far-sighted.
Yeah. Yeah, that's for sure. The quarterly mindset. So now that silver is loved, what other resources can we look at that are still hated?
It's getting scarce. Sulfide nickel is hated. If you had talked to me 4 months ago, I would have said oil and gas.
Yeah.
I was a wild buyer of Exxon at 100. I'm a little less wild at 160. I think the oil trade's actually ahead of itself. I think it has a long way to go, but I think it goes lower before it goes higher. There are some subsectors that I like. Mostly, I've been expressing my love for oil and gas, or rather, my love for the hate surrounding oil and gas, and the great big companies, because I thought they were cheap. What's happened to me very, very, very recently is I found my portfolio way out of balance to beta away from alpha. And there is a speculative subclass, which is companies with sub $250 million market capitalization that are involved in offshore conventional exploration rather than onshore shale plays, which are what the market likes, in third world, emerging and frontier markets. All of the speculative premium that surrounded that sector for the last 40 years, it was a very good sector for me, by the way, all that speculative premium is gone. Mm-hmm. So very recently, I've assembled a portfolio personally, and I'm not going to name the names because I'm still assembling that portfolio, and I don't want 10,000 of your listeners competing with me. But the 5 companies share similar characteristics. First of all, there is somebody in management or on the board who I know and love and trust, so that the information I get, while not inside information, is certainly nuanced and good. The second is that their projects have to have analogous production in the same basin, in the same trend, and they have to be well seismically supported. And the third characteristic is that the seismic signature has to be big enough that if by some odd chance I'm successful with the well, that I get a 15 or 20 to 1 return. The arithmetic on that speculation goes like this. These seismically supported big structures with analogs have a 25 to 35% probability of success. So if you're taking 5 starts, you have a statistical probability of 1 success. If you lose 35 to 40% of your money on the 4 unsuccessful tests, and you make 15 or 20 to 1 on the one successful test, when you aggregate all that arithmetic, you have a pretty good outcome.
Yeah.
If you have the emotional and financial wherewithal to stand the trade, particularly stand the trade if against all odds you strike out, you go 5 for 5, bad.
Yeah. Well, oil exploration is a whole different animal than it was 10 or 20 years ago. The risk of dry wells, is minuscule compared to then, right?
Much lower. When I was involved in exploration, well, for my employer's account, not for mine, I didn't have an account then, these deep wildcat wells onshore had a 10% probability of success. Now, these much more expensive offshore wells have a 25 to 35% probability of success, provided that there's good seismic coverage and there's a producing analog.
Yeah, and if you got a good guy on the rig there, it's even higher, right?
Well, that could be. I'm one can assume that somebody who's manning a rig for Exxon or Shell or Total,
Yeah.
one would guess they're pretty good.
Yeah, for sure. All right. So these foreign deep water explorers.
In countries that most people hate or can't spell or pronounce.
And can't find on the globe, right?
Correct.
Have no idea where they're at. So what about gold and silver miners? Now, gold miners are printing money. Is that going to continue, or are we going to retrace? What's going to?
Well, in the very near term, what intrigues me is I keep sitting in on conference calls and reading Bay Street and Wall Street research, and the earnings estimates are based on $3,200, $3,300, $3,500 gold. If you're selling gold for $5,000 and the estimate has you selling gold for $3,500, it's pretty likely that you're going to surprise folks.
Yeah, I would say good chance of that.
One of the things I did, Kerry, when I sold my silver is I redeployed half the money into silver stocks, high quality ones. Here's why. If from $75 as an example, silver traded sideways for a year, which I don't think is unlikely, by definition, if silver trades sideways, I don't make any money on it, right?
Right.
But if silver maintains $75 and traded sideways, given the fact that the earnings estimates for the silver companies are predicated on $45 silver, if you make the stuff for $75 as opposed to a $45 estimate, you do pretty well. And it causes Wall Street and Bay Street to redo their net present value calculations. So it's not unlikely, if a $75 price environment is maintained, that the silver stocks are up by 45 or 50%, even while silver goes sideways.
So
ironically, if the silver price falls, the net present value calculations probably don't change much, because from $75 to $45, that $45 is the basis of the existing net present value calculations. So it's a very interesting, very asynchronous bet.
And yeah, it really is, because your downside is limited, because basically you wind up with what you have now. But if the price shows any strength, any resilience, which I think you're probably correct. I mean, I don't want to predict silver prices. It's easier to predict trend than the actual price, for sure. But yeah, if it just stays where it's at, these guys print money. So and that's the lag time between the price appreciating and then the downstream effects being understood by Wall Street. And this is something that happens a lot, doesn't it?
It does. Now, your listeners need to understand that this is a strategy that doesn't play over a long weekend. I'm talking about arithmetic. And arithmetic always lags narrative, which is to say, if the silver price fell from $75 to $45, although the silver stocks would be appropriately valued, they probably would fall in price for a year or 18 months, because the narrative would be that silver was a bad place. People wouldn't look at the industry's free cash flow at $45 or the net present value of future cash flows at $45. They would look at the fact that the silver price and silver stocks fell, and they would react in a narrative rather than an arithmetic fashion. 18 months, or let's call it 30 months from here, cures that, which is to say, over time, the narrative has to surrender to arithmetic. But it doesn't surrender to arithmetic in a time frame that's often suitable for speculators.
Yeah. Interesting thing is, in 1960, silver was 90 cents an ounce, So I'd say the price of silver is more than kept up with whatever the real rate of inflation is, which we'll never know, A, because it's impossible to know, and B, because even if they did know, they wouldn't tell us, right?
Right. That's something we should talk about, Kerry. Even listeners of yours, let's just say they're far enough off Main Street to listen to you.
Very far off. Like they took a turn off Main Street and they never found it. They never got back again.
Yeah, and whether that was rational or bourbon infused, even your listeners, I think many of them, conflate the CPI with the rate of deterioration of the U.S. dollar. And that's wrong. We have been conditioned by this factoid called the CPI. The CPI is an example. When it's inconvenient, doesn't include food or fuel. If somebody saw both you and I walking down the hall, they would conclude that an index that didn't include lunch was of no interest to you or I. I mean, arithmetically, I would urge your listeners to do a back-of-the-envelope fact check and ask themselves in the period, say, 2020 to 2026, whether the basket of goods and services that their household consumes has only become 2.6% more expensive year on year. This is insane. Yeah. I mean, this is truly insane. I did the calculation myself informally. I didn't audit every purchase I made, but I looked at things like health insurance,
car insurance,
mortgage interest, things like that. It would appear, and by the way, I'm an old cheapskate. I don't buy much. But it would appear to me that the deterioration in the purchasing power of my savings relative to the basket of goods and services I buy, it would appear that the deterioration in value is between 8 and 10%, not 2.6. That becomes problematic for people because people who are planning their life for the next 10 years against a 2.6% deterioration in their purchasing power are going to make an enormous mistake. I really think it's important that when people think about how they're going to sustain themselves for the next 20 years, that they ignore the CPI and think about a number that's closer to their own experience. In the decade of the 70s, which you and I remember, Kerry, but many of our contemporaries don't remember, the basket of goods and services that one could acquire in 1970 for $1,000 cost $4,000 by 1980. If you were living on a fixed income, or if you had your savings deposited in a bank account, earning 4.2 or 4.3 against 12% inflation, you had a very ugly experience in the decade of the 1970s. And I would ask your listeners to think about their own financial plan in that context.
Yeah, it's so true. The numbers do not reflect reality by any stretch. But interestingly enough, in 1970, I think it was 2 silver dimes bought a gallon of gas. Right. And now 2 silver dimes buy I don't know, I did the math. I think it's 6 or 8 gallons of gas, which in itself tells you a lot. Now, obviously, there were times when the purchasing power of physical metal actually declined, like I think in 1980 or 90, I don't remember. But it actually declined. But those were anomalies in the course of time. So that tells you a lot right there.
Well, certainly 2011 to 2013, there was a real dump in metals prices and in the real purchasing power of metals. Perhaps by fortuitous luck, but I hope by experience, I began to save. Let me rephrase that. I began to incorporate a substantial amount of gold in my savings, maintaining liquidity in U.S. dollars and maintaining liquidity in gold too. But really, my permanent savings became more and more gold dependent. Interestingly, about 6 months ago, I have some of my money managed by a multifamily office. And I've told them they can do anything they want except for precious metals and natural resources. In other words, I want that part of my portfolio out of my own harm's way. And I sat down with the portfolio manager there, who has always been interested in my portfolio. Sure. He does what I do, and I ask him not to do what I do in my own portfolio. And he showed me how much more affordable things are for me. As an example of being on the golden constant. He showed me an index of the S&P 500. He showed me an index of home prices.
Yeah, exactly.
He said, interestingly, Rick, for you, really, things are much cheaper than they were in the year 2000.
Isn't that wild?
I hadn't thought of it in that context, but
it's wild. I'm actually doing a report, not to plug it here, but tracing the purchasing power of silver, gold, and the U.S. dollar on things like cars, houses, Thanksgiving meal. Like a Thanksgiving meal used to be like an ounce of silver back in the 60s bought a Thanksgiving meal. Right. Now, an ounce of silver buys multiple meals, good half a week's worth of meals. It's a fascinating study that I don't think is done enough. I'm calling it living the silver-backed lifestyle.
For you.
And it's just a fun exercise for all you subscribers out there. Hey, this discussion would not be complete without a discussion of AI, because we're both very aligned on it. It's worse than garbage in, garbage out. It's like garbage in, and you don't know what is going to come. You said it, and I had said it myself, that if you don't ask it the right questions, you're never going to get the right answer. And the ability to ask it the right questions isn't something you can just pick up. It's something you have to suffer through a lifetime of investment mistakes and catastrophes to really know what to ask it, right?
I would say in my hands until a year ago, AI stood for artificial idiocy. What AI did when I asked it a general question before I knew how to constrain it was it would search for consensus opinion on X. In other words, it was a compendium of the beliefs of every moron on the planet, which was not of particular use to me. The more recent versions of AI, if you understand how to constrain them, are miraculous. My partner in the real classroom, Albert Liu,
I know,
who is, he was a semiconductor engineer before he came over to the dark side. He's really pretty good at technology. He said, Rick, we're educating AI with your YouTube talks.
Yes.
And with the lesson from the classroom. And pretty soon, I'll be able to duplicate and fire you. You will become redundant because AI will be better at your mannerisms and your quips than you are. The great quips that you had the great quips that you had 25 years ago, Rick, you've forgotten. But AI hasn't, and they'll be able to recycle those quips into today's circumstance, and AI will be a much better Rick Rule than Rick Rule.
Well, I mean, you're still coming up with quips. The creativity aspect is interesting, but the ability, I mean, I watch a good amount of YouTubes, and I have to be totally on guard to see if it's an AI. There's certain ones that are so good that I just have to know. And then they're going back to historical stuff, different works that people did, and they're creating new works and quoting them. And if you didn't read the original, you wouldn't know that this was all fake. And in fact, I had to use AI to prove that something was fake because I knew it wasn't right. Now, I uncovered a scam, a nationwide scam. I'm dropping a book next week, and this is the cover of the book, and it's America's Great Parking Scam. You've been robbed. And basically, it's like, I didn't even know this until I used the AI, but there's a standard for signs on the highways that's federally mandated, that's been adopted by every single state. It includes parking signs. They're called traffic control devices. That's signs, that's stop signs, traffic lights, flashing lights, lines on the ground, all of this. It's all standardized, and everything is paid attention to except parking. Nobody cares about parking signs. So I'm dropping this book. I'm starting a lawsuit on it because I'm tired of the parking grift, the nickel and diming of the government. But without AI, I would have never discovered this, or it would have taken me years to figure it out. All of this is encompassed in this book, Compliments of the U.S. Department of Transportation, the Federal Highway Administration. It's only about 1,200 pages thick. If I had to read that frickin' thing to find all this, would have never happened. So when you talk about Albert and you yourself and the way, if you use it properly, it is a force multiplier. And I tend to think that it's consumption of silver by AI is not all they're saying it is. I think it's exaggerated, but it sounds good in the media, right?
Yep. You know, one very interesting thing that I've seen, when I first came into financial services, I was an intern, which is finance speak for slave, to a wonderful, legendary value investor named Peter Cundall. Mm-hmm. And working for Peter Cundall, you take 5 years of quarterly reports, physically remove the staples, and lay them out along a long conference table.
Oh,
you know, and
you really are dating yourself.
Yeah, Peter Cundall was a great fan of the Ben Graham net sort of thing. So you'd look for companies that were selling at discounts to the value of their working capital, and you would take weeks doing this in one industry. Doing comparative net present value calculations could take 6 weeks. We, not me, but a young person who's a member of the Rule Classroom helped me do this very recently with AI. She said, search exchange databases worldwide and give me a list of every company in the world that has negative enterprise value. In other words, a company where the market capitalization and their debt was less than the value of their current assets, either inventory or cash.
Right.
Where those companies are cash flow positive. In other words, where they're not falling knives.
Yeah.
And AI churned around for about 3 minutes. 3 minutes.
It took that long, huh?
And produced a list of 70 companies.
70? I can't believe there's 70 nets floating around in the world.
Well, what AI isn't very good at right now is looking for extraneous problems like lawsuits hanging over them, stuff like that. But the fact that it could find 70 companies worldwide that were nominally at least cash flow positive with negative enterprise value, astonished me. There's warts, by the way. You know, there's probably 10 in Japan that are 80% controlled by one family. Uh-huh. So, you know, you can't get much benefit out of that. But
lawsuit risk is good. As a lawyer, I can judge. I can value lawsuit risk, especially using AI. Some of the best hits I've ever had were lawsuits where the stock was artificially depressed, like TiVo, dating myself here. There was trading for nothing. And they won their lawsuit, which I knew they would, and then they won their appeal, and it went up tenfold. So, it's spectacular what you could do, and I don't really think AI needs as much silver as they're claiming it needs.
But, you know, my hope, Kerry, I think you know that I spend a lot of money maintaining a database of public companies in the natural resource business. And we use those, we use them for my own account, but we also use them to rank portfolios as a free service for people. And young people in the Rule Classroom and at the Colorado School of Mines believe that they can automate about 95% of that database for me. I'm spending right now about $350,000 a year on that database, on consultants.
Oh, there's no question it could do it. There's no question because you got a starting point. Yep. If you didn't have anything and you wanted to assemble it, it would be a bigger challenge. But it's running now, so it's just creating agents to do all that stuff. Like
it has now a 35-year history of upgrades and downgrades. Yeah. So they can artificially reassemble 3 decades of thought process.
Yes. Yeah, it's spectacular. So it is the future. Do you think it's going to have these humongous job displacements that they're predicting?
I think so. Yeah.
I do too.
Which is, probably not all bad. You free up people to do something that generates more value for society. I mean, certainly the young analyst, Rick Rule, the young slave working for Peter Cundall, would have been replaced. But Rick Rule's ability to understand how to ask it questions
Can't be replaced.
Yeah.
We can't.
Just unbelievable. So, I mean, I think for people who Robert Reich would have described as symbolic workers, knowledge workers, AI will be truly a thing of beauty. For people who don't think a lot about their work, they just try to show up and make some money, that is not going to have a happy outcome for them.
And I'll tell you, I've had Tesla for years, and the full self-driving, according to the stats on the car, and I think they're conservative, it says the FSD is driving 95% of the time. I think it's closer to 98 or 99 because I hardly ever drive. And I will confess to actually having fallen asleep in the car when it's driving. Right. Not a smart thing to do. But honestly, what kept me up all these years was having to concentrate on the highway, to evaluate all the threats constantly emerging, past, present, right, and future threats. And now, Rick, especially on the highway, it drives better than me. There's no question. Does it have quirks? Yeah, but I got quirks too.
Yeah, I was going to say, does it get drunk?
No, and it doesn't get tired, fatigued. It is, and that, to me, it says everything because
think about this. Think if Elon Musk ever went into the auto insurance business. He has automatic data on every driver that drives a Tesla. He can price the insurance to the risk of the driver if the regulators will let him.
He's in it. He's got it in, I think, 12 or 13 states. He just started.
What amazing data that is.
Yeah, well, they asked Warren Buffett about it. And he said, the car insurance, the insurance business sounds real great as people send you money and you send them pieces of paper, but it's a little more difficult. But he never had real-time data on millions of vehicles. And, according to Musk, and I don't know if it's true, like I said, it's one of those AI things that I want to see the numbers on. It's 3 to 4 times safer already than human driver. But, when it comes to parking in the parking lot, it's not so good. And I don't trust it, where there's all sorts of stuff going. But it's just a...
But, Kerry, that isn't where the risk in auto insurance is. Mm-hmm. A federal end, yes, they have a claim, but that's nothing like $1 million in liability for hitting somebody.
Yeah, or on the highway, that's, highways are actually safer. It's actually the local streets where the worst accidents take place. Counterintuitive. But, Rick, I always appreciate you coming on the show. One of the great things about you, global thinker, you don't think in terms of data points. You think in terms of systems and in terms of patterns, pattern recognition, and pattern recognition. That's something that AI really excels at, but it's something that they don't teach consciously in our schools, our universities. There's no course in pattern recognition. Course in logic, yes. History, whatever, but there's nothing in pattern recognition. If you were going to teach a pattern recognition course, how would you teach it?
Interesting question. I haven't thought about it. I guess in order to make people assimilate it, I would have to show synchronous and asynchronous patterns on some subject that I could make autobiographical because people relate to people.
Sure. Yeah.
So I guess I could do it in the context of the oil market and the oil stock market going back 45 years. The thesis would be, in terms of pattern recognition, the cure for high prices is high prices. The cure for low prices is low prices. And the variable is taxation and interest rates. I could probably do that. now that you mention it. I hadn't thought of that question until you asked me. But I think the easiest way for me to teach the course would be to take the oil industry from 1965 to 2026 and teach cyclicality and variability. And there'd have to be three variability scales. One would be technology. The second would be theft, aka taxation.
And regulation.
And the third would have to be real inflation-adjusted interest rates. And I think you could teach a pretty good pattern recognition course doing that.
Yeah, because that's what AI is really all about in the end, pattern recognition. And how you refine that pattern is how useful it becomes. And, it's something you've been doing unconsciously your whole life, while you can look at a stock market chart and predict with reasonable degree of certainty where it's heading next, or where the trend is, or where you want to be in 3 years, but the market's not there yet. And I think there's some value to it.
And AI probably, maybe you know the answer to this, I suspect that AI probably would be able to, looking at a 50 or 60-year chart like that, point out what the most relevant variables were. In other words, you will probably be able to figure out taxation, technology, and real interest rates without being prompted.
Yeah. Oh, for sure. Because, that's where the mastery in crunching all those numbers, decades of numbers that, humans can't even do it. That's why we use charts, because we can't comprehend the numbers. Yeah. Well, just something to think about in any event. Appreciate you coming on. Hey, Rule Classroom, how do you sign up for the Rick Rule Classroom?
3 things I want to tell your listeners about, if you'll permit me. The first is, given that I spend $350,000 a year maintaining a public company database in natural resources, I'll give you that database for free. Send me your natural resource stocks. List your natural resource stocks at ruleinvestmentmedia.com. And for free, I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments have value. Please, no crypto, no tech stocks, no pot stocks.
Yeah, no klepto.
I don't do those. Okay. The second thing is, at the Rule Classroom, we now have 17,000 students who are for free accessing well over 300 hours of instructional material at the Rule Classroom. 5.5 hours on Introduction to Natural Resource Investing. There's also the Rick Rule channel and the Rule Investment Media channel on YouTube. But we also have one other event coming up, the 30th Rule Natural Resources Investment Symposium in Boca Raton, Florida, July 6th through 10. The finest natural resource conference, I think, on the planet. We will sell out of the live conference this year. We'll sell it out within 30 days for the first time in 20 years. We have, unlimited access online. So, Rule Investment Symposium, July 6th through 10, Boca Raton, Florida. If you think for any reason you didn't get your money's worth, we'll give you your money back.
All right, I'll give you your money back, because let me tell you, I've been to, I don't even know how many of them, Rick, back in Vancouver. And, obviously I'm not looking for, but everything I learned there, I monetized it, everything. And the people you meet, the other thing is why I love resource business better than any other industry. Everyone's a character, number one. You're not going to see straight-laced Ivy League, like lawyer types, white shoe firm types. Forget that. But they're all smart and they're all problem solvers. And when you get that many problem solvers under one roof, something magical happens. The impossible becomes possible, and it rubs off on you. I don't think I'm that bright. Believe me, I don't. But when I'm around smarter people, it makes me smarter.
Also find they're pretty nice.
Yeah.
We've got a couple speakers. Nomi Prinz comes to mind.
Oh, yeah.
Very, very, very famous person. She comes to the conference. She hangs out at the coffee pot. She hangs out at the bar. She goes on the boat cruise. Eminently approachable.
Yeah. Yeah. And you're eminently approachable. I mean, I started this 15 years ago, Rick, and you're the most generous going on people's shows of anybody out there. But yeah, good people, problem solvers. They're actually trying to make a difference. Hey, we're all driven by the profit motive, but these people are special. And it's really, because to have survived in the resource sector this long, you got to have something extra. You can't just be a schlepper or I'm trying to remember what somebody once told, a slacker. Somebody once told me, I was in San Diego, and he said, yeah, it's a great place, but it's land of the slackers, which is why New Yorkers can do so well. So you can't be a slacker and make it to the Rick Rule investment conference. You just can't.
Well, we look forward to your non-slacker audience visiting us. By the way, if you come either live or live stream, you'll have access to the recordings of the conference for a year, and you'll need them. We're going to give you more information over 4 days and 46 hours than you can absorb. So when I tell you it's going to be 4 days, for everybody to get their money's worth, it's going to be 8 days. Attending the conference and then playing back the recordings.
Yeah, and great people. It's so worth it. And really appreciate you coming on, Rick. I'll have a link to Rick's various enterprises in the show notes. Highly recommend the classroom. I'm signing up for it right away. I didn't realize you were doing it. And hey, look forward to seeing you in Boca in the summer. And you be well.
Thank you. And you as well. Thank you for the opportunity to have this discussion.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.